Good morning, everyone. Thank you for attending Allied Insurance Brokers Workshop on state unemployment insurance. State unemployment insurance for nonprofit organizations is a little bit different, being the fact that all other employers outside of the nonprofit, which is specific to the 501c3, as well as the governmental sector, don't have options in regards to how they cover their unemployment insurance. But 501c3s and governmental entities do. So that's what we're here to discuss about today. The slides are going to be in three different sections. First, we'll talk about a little bit about the options available to 501c3 nonprofits. Then we'll look specifically at the state unemployment insurance market in the state of Pennsylvania, as well as on a national level. And then we'll finish up with our products as far as what we offer with Allied and First Nonprofit. Just give you a little background on First Nonprofit. We're based out of Chicago, Illinois. We are a property and casualty insurance company. We offer financial and insurance products specifically to the 501c3 sector. We're rated A- excellent by AM Best, which is the most recognized insurance rating organization. We've been providing insurance products since 1978. Our state unemployment insurance programs currently cover over 1,400 nonprofits, which is over 225,000 employees. Kind of give you an idea as far as who we work with on a national basis. On the local side, we are endorsed by both the Pennsylvania Association of Nonprofit Organizations as well as the Pennsylvania Care Providers Association. State unemployment is a little bit different. Probably the closest thing would be workers' compensation. Like workers' compensation, the benefit tie is to a certain characteristic. Unemployment compensation is based on wages. There are no classifications of employees. So if an employee works in the administrative level or he or she works in the warehouse, essentially their job duties don't make a difference. Essentially how much a claimant is entitled to in regards to unemployment is specifically based on how much he or she earns in wages. So at First Nonprofit, we work with all kinds of different organizations all across the country. As I mentioned before, organizations with a 501c3 tax classification have options in regards to how they cover their unemployment insurance. Like employers, they are required to provide this, but they're not required to insure the benefits in the form of the state tax. And that's something that we're here to discuss as far as what options are there out of insuring out of the state unemployment compensation tax system. For nonprofit organizations, we're going to look at two. The most common one is insuring through the state tax fund. And how that works in the state of Pennsylvania is employers are assigned a rate on a calendar year basis, and they pay that rate on the first $8,000 per employee. For calendar year 2011, the minimum rate assigned to an employer is 2.677%, and that maximum rate is 10.8236%. As I mentioned before, that rate is assigned on a calendar year basis. And how it works is at the end of each quarter, every employer reports their gross wages as well as their UI taxable wages to the Pennsylvania Department of Labor. Essentially, the gross wages report lets the state know as far as who's on your payroll, how much have they earned, and when the time comes for the unemployment claim, they have the wages present to determine how much their benefit or how much they would be able to collect on the claim. In addition to that, the premium that the employer pays into the fund is based on that UI taxable wage limit, which again is exclusive to the first $8,000 per employee. So at the end of the quarter, the employer reports its payroll. In addition to that, makes its contribution into the fund. The second option, which is only available for 501c3s, is called becoming a reimbursing employer. And essentially, the reimbursing employer is an employer that is responsible for claims paid only. So, for instance, in the state fund, if you have a 3% rate, okay, and you're in the UC tax, and you have $1 million of taxable payroll, you're going to be responsible to pay $30,000 into the fund, regardless of what you paid out in benefits. So let's say, for instance, that you paid out $50,000 in benefits. Well, if you were in the state tax fund, you'd be paying $30,000. If you were a reimbursing employer, you would essentially be responsible for how much was paid out in claims. And in this case, the state fund paid out $50,000 in claims. So when you're in a reimbursing configuration, you become responsible on a claims paid basis. It could be $0 for the year, it could be $50,000. That all depends on how much your former employees collect. So as a reimbursing employer, there's really a couple different options. An organization could self-insure the benefits, or they could participate in a risk pool, a trust, or insure through a third party such as First Nonprofit. How that works is any employer that is not insuring through the state UC tax is required to provide a surety bond. Okay? Once that organization places a surety bond, they're then eligible to be on this reimbursing configuration. So what happens is that the state at the end of each month sends the bill for actual claims paid. For an organization that's self-insuring the benefits, the employer simply just reimburses the fund based on those claims paid total each month. If they're working through a third party, depending on what kind of configuration it's based on. So what we want to do is we want to look at the pros and cons of the different setups. Looking at the pros of the state UC tax or the SUI tax fund, the main advantage is it's a fixed annual cost. So in the insurance industry, we would consider this a guaranteed cost. And the reason being is the UC tax is a first and last dollar coverage. As I mentioned before, if you had an assigned rate of 3% and you had $1 million in taxable wages, you're going to be responsible to pay $30,000 into the fund. That's regardless of your benefits for the year are $1 or if they're $50,000. Okay, you're going to pay $30,000 into the fund. So there is no risk beyond the assigned tax rate. So for a lot of nonprofit organizations, having that budgetary certainty to allocate the program, to budget for is extremely helpful. The disadvantages of the state tax fund are all based on the fact that it's a shared risk pool. So anytime you're in a shared risk pool, really the overall solvency of the fund is going to determine the rate. In the state of Pennsylvania, there's roughly 5 factors that make up the individual employer's experience rate. Only one of those factors, excuse me, 2 of those factors are based on the employer's individual experience. The other 3 are based on what's going on in the fund. So what we've seen in the past couple of years, as the fund has had to pay out more claims, thus driving the balance down, the fund has had to raise rates on employers. And essentially, the employer's contributions into the state fund, as well as the contribution by the employees, are the insurance provider for state unemployment. That being said, when there's more in claims that are being paid out than are being collected, there's a lot of socialized costs, and socialized costs are shared risk. So, for instance, if an organization goes out of business in the state of Pennsylvania, and they had 50 employees, well, now there's 50 employees drawing benefits, but the day that that employer stops filing or reporting wages in the state of Pennsylvania, that employer is no longer responsible to pay state unemployment insurance. So you now have 50 employees drawing benefits. Another example is there's a lot of employers that pay more in claims than they pay in premium. Again, there's a stated maximum. Right now it's a little bit under 11%. So if you apply that 11% to the first $8,000 in wages, you essentially have $880 is roughly the maximum contribution per employee. Well, there's, in this case, in the state of Pennsylvania, that's less than 2 weeks of claims. So you can imagine there's a lot of employers that do pay out more in claims than they pay out in premium. So that being said, the solvency level, socialized costs, and all this drives to the fact that really the overall indicator of what your costs are going to be in the state fund is based on the overall condition as far as how much money, how solvent is the fund. The final disadvantage is really based on cash flow. When you're contributing on the, when you're paying on the first $8,000 per employee, most organizations pay their annual liability in the UC tax by the end of the second quarter. So for a lot of organizations, it's an upfront cost. Now we're going to look at the reimbursing side. And again, reimbursing is when an employer elects to be responsible for claims paid to its former employees. Okay, essentially you're reimbursing the state fund dollar for dollar for unemployment benefits. And the advantage of that would be lower costs. So instead of paying essentially this socialized cost, as we mentioned, you're on a per claims basis. And for a lot of organizations, they're better off being responsible for their own experience versus subsidizing other employers, which is what you get a lot in the state fund. The disadvantage of that is if you're an organization that's self-insuring the benefits or in a third-party plan without some sort of cap, is there's no limit to the aggregate annual cost that an employer is exposed to. So, for instance, right now in Pennsylvania, the claimant can collect on standard unemployment up to $14,664. That's the per claimant cap. But essentially, if you're an employer and you had 100 employees and 100 employees filed for unemployment benefits, you're looking at an annual exposure over $1.4 million. So for a lot of organizations, especially in this type of environment, the thought of self-insuring is a little bit scary. In that case, it makes it difficult to budget for. Most situations occur in the form of layoff, and in that case, that means some sort of funding source or a program is discontinued. So there's a severe fluctuation in cost for organizations who are self-insured. In addition to that, when you're in the state fund, you have a right to protest or request non-charge on all types of claims, because essentially there are certain claims that the state fund will pay out, but not charge an employer directly. For organizations that are reimbursing, there are certain claims. For instance, if a former employee has to leave due to domestic violence issue, then a reimbursing employer would not be able to request a non-charge on that type of benefit. So a reimbursing employer may be responsible to pay that claim directly, where an organization in the state tax fund would not be billed for that claim. So that's essentially an issue that all reimbursing employers have. One of the reasons that we mention that is we let organizations know that they can't assume that their liability in the state fund is identical to their liability if they're out of the state fund. The final thing is regarding tracking credits. And essentially on the credit side, if an organization is in the state tax fund, and let's say, for example, at the initial level, a claimant is awarded benefits, at a hearing level, that decision gets reversed. Well, in the time between the initial determination and the hearing, the claimant has been drawing unemployment benefits. At the time that the decision reversed, the claimant is then required to pay the state fund back. As you can imagine, that takes a little bit of time for that to occur. So in the meantime, if you're in the state tax fund, they automatically credit your experience, so it's not included towards your experience calculation. Whereas if you're a reimbursing employer, you essentially don't get credited until the claimant pays the state fund back. So as a reimbursing employer, if you don't have a third party tracking the credits for you, that's something that you would have to take in-house to make sure that when the claimant does pay the state back, that it gets credited to your account. Right now, we're going to go forward and look as far as what's going on in the state fund. And again, just to kind of recap how it works, is that the contributions by the employer, which essentially make up 99.99% of the state fund, are required to cover benefits paid out to claimants. Well, that hasn't really been the case in the past couple of years. Really, since 2009, the federal government has been paying claims on behalf of the state of Pennsylvania, and this is in the form of the Title 12 program. Really, the insurance carrier being the employer fund, well, the reinsurer is the federal government. So in our case, in the insurance industry, if the insurance carrier goes belly up or insolvent, the reinsurance kicks in. Well, the reinsurance for the unemployment system is the federal government in the form of the federal unemployment tax accounts. And in the state of PA, this has really been the entity that's been covering benefits for the past couple of years. At the time that this was run, That borrowed amount would essentially be the deficit balance in the fund. The fund was essentially at a negative $3.92 billion balance. And as you can see, over the course of the recession, the fund became insolvent in a short period of time. In mid-2008, there was a little bit less than a $2 billion surplus. As we find ourselves today, the deficit is over $3 billion. This is an illustration as far as how this has affected the cost per employee. And as you can see, in calendar year 2008, that cost per head was based on the fund balance in 2007, which was flush. In 2009, that was based on the fund balance roughly about July of 2008. And as I mentioned before, it was now at a $2 billion surplus, a little less than. In 2010, as things started to slide, the cost per employee increased to $529 per employee. In 2011, they've yet to post any figures, but the estimate we know is higher, just for the fact that there's now an interest assessment of 0.44% that's included in everybody's rate that insures in the form of the UC tax. So just a rough estimate of that. We assume right now that it's somewhere in the ballpark of $565 a head would be the average employer's cost, just using the interest assessment addition. To give you an idea of just how insolvent the fund has gotten, in calendar year 2010, for every dollar that was paid into the fund paid out $1.77 as benefit. So essentially, it was at a negative 77 cents. To illustrate the socialized costs, there was over $646 million in claims were attributable to inactive employers, such as those went out of business, or claims that were non-charged to employers. So 16% of total claims paid were really just an illustration of this shared cost. The final bullet point, which is reach solvency. In 2010, the average rate was 5.78%. Based on the recommended Department of Labor guidelines for a fund to be considered solvent, in the state of PA's case, which means outside of that $0 balance, the state would have to raise rates on average to 8.47%, which is a 46.5% increase. So you can see essentially how insolvent the state fund is. More importantly, what's the path to recovery? This isn't a short-term issue right now for the employers in the state of Pennsylvania. The UC tax is going to be a significant cost for a long period of time. The really question is that as a 501c3, are you better off covering your unemployment through the UC tax, or are you better off being underwritten based on your individual merit as an employer? And that's really what drives the decision whether or not reimbursing is better for an organization, or are they better off being in the state fund. State unemployment has had a lot of influence in regards to things happening at the federal level as well. Pennsylvania is one of 27 states right now that are essentially on this Title 12 loan program. Although Pennsylvania's $3 billion in deficit, aggregately these funds are $38 billion in the whole. The special assessment that was included in an employer's rate in calendar year 11 was attributable to this loan. And how it works is that if the state fund is on this Title 12 loan program for 2 calendar years, then there's interest assessed on the employers, and that's why the state rates included a 4,400%. In addition to that, there's also some other things that are going on at the federal level, and plain and simple, this is just pointing to the fact that employers are going to be required to pay more in state unemployment insurance coverage. The federal government has kind of been trying to balance as far as what's been going on. Obviously, the business community has been pushing the message of not increasing costs on employers, to basically discourage any hiring, so not to stunt any potential job growth. So what the administration has floated is they have offered to waive the interest payments due on these funds that are borrowing for calendar years 11 and 12. They would with the two calendar year waiver, they would pick it back up in 2013. So for instance, it would just extend the interest free on these loans, which in this case would be attractive for a lot of states. In addition to that, there's something that's specific to the federal unemployment tax, and although that's not applicable to the two 501c3s, it is applicable to the business community as a whole. And essentially, right now, if a state fund has a principal balance for over 2 calendar years, not only is their interest assessed, but they also lose 0.3% in regards to its FUTA credit. And how that works is that if the state is current on its state unemployment contributions to the feds, then they receive a credit in regards to federal unemployment taxes. Well, when a state fund is insolvent or essentially on this loan program for 2 years, the employers lose 0.3% credit, and they pay FUTA on the first $7,000 in wages. So that 0.3% on the first $7,000 means that the employer will be required to pay $21 more a head on the employee in regards to FUTA. This just illustrates all the states that potentially have this issue of the FUTA credit reduction, which will occur here at the end of calendar year 2011. So the feds have offered to suspend the increase on the employers, but to do so, they need to address long-term solvency, because right now, between the federal extension of benefits and the Title 12 loan programs, they've had to borrow from the general treasury, thus increasing the deficit, which most people are trying to put a halt on. So to do so, the feds are proposing to increase the taxable wage base. This is going to be specific to federal unemployment taxes. Right now, the federal minimum is $7,000. They want to raise it to $15,000. And again, that's federal unemployment. But the issue on it is the state minimum must match the federal minimum. So essentially, any state that was below the $15,000 threshold on UI taxable wages, for example, Pennsylvania, who's at 8, would be required to raise that limit to the first $15,000 per employee. So as you can imagine, that's a significant difference in cost to the employer. So the reason that this proposal has some traction is in regards to the overall savings offered to the employers. Just based on the interest assessment suspension for 2 years, that would save $3.6 billion. The FUTA credit suspension would save $6.7 billion. So, a little over 10.5 is essentially what we're looking at, aggregately, and that's pretty attractive. And the whole reason for this is the federal government needs to restore the state trust funds from this insolvent state. And right now, at the rate of borrowing and paying back from the state funds, by 2020, there'll be 17 states that would still be in the red. They're looking to accelerate that to getting it down to 2 by 2020. And essentially, that would be based on the increase in the wage base, which would not make an impact on federal unemployment tax contributions. They're specifically trying to do this to increase the solvency in the state funds. That being said, short term, employers' costs are going to rise for unemployment insurance. And as you can see, long term as well, the only way that the funds are going to be restored to solvency is to start collecting more from the employers. And that's essentially the situation we're in. So as a 501c3, there are options. The question is what's the best option for your organization? So now we're going to talk about as far as what we offer at First Nonprofit. We're going to look at 2 of our program offerings. The first one being the bonded service program, which is very similar to an organization who's insuring through the state tax fund. Our second option would be the unemployment savings program. And this is just a little more aggressive option. It's probably closer to somebody who's self-insuring. But those are the 2 main ones that we're going to look at. So Starting out with the bonded service program, there's some similarities to this with the state fund, but there are some differences. First and foremost, like the state fund, it is a first and last dollar coverage, so it's a guaranteed cost program or essentially a fully insured option. So you get the same sort of fixed annual cost and budgetary certainty that the state fund provides. One of the differences between our fully insured option and the state fund is our premium is set at a percentage of gross wages. And the reason that we do that is how much an organization's risk is, or how much a claimant is entitled to collect in unemployment benefits, is based on his or her gross wages. So in the state fund, there's an $8,000 number. That's the cap that the employer pays premium on. Well, if you have an employee that makes $20,000 a year and an employee that makes $40,000 a year, in the state fund, they're both an $8,000 number. Well, in regards to risk, the employee who earns $40,000 a year is going to be entitled to a greater value of unemployment benefits than the one who earns $20,000. So our premium is set at a percentage of gross wages because we specifically look at an organization's individual risk, as far as that risk specific to that organization. You're going away from a grouping type underwriting, which you receive in the state fund, and now you're being evaluated based on your own merit. So our premium is set as a percentage of gross wages. Another difference between our program and the state fund is we can offer an experience credit or a refund. And essentially in this case, if an organization's losses or claims paid are less than anticipated, our insurers can get a percentage of that back. In the state fund, if you pay $50,000 into the fund, if you pay out $0 in benefits, again, the state fund doesn't have the option of issuing this type of experience credit. It's not legally possible for them. Another difference in our program is we bill in equal quarterly installments, and at the end of the year, based on reported payroll, the payroll is audited and any adjustments are made. So for a lot of organizations, instead of paying up front, like in the state tax, being able to pay in equal quarterly installments is helpful. Final difference between our program and the state fund is we also provide loss control services for the insured. That's in the form of claims administration. So we have a third-party administrator that assists our insureds with the claims process, which we'll go into in greater detail here in the next couple of slides. And more important, why most organizations are really looking at this type of thing, is what's the difference in cost. And from 1998 to 2010, our guaranteed cost coverage was 27% less than the state funds or the state UC tax. And in that case, that doesn't include the experience credit. Our second option is the unemployment savings program. And as I mentioned before, this is a little bit more aggressive approach in some cases. The backbone of this program is a proprietary reserve account. Right now, in the state fund, the state owns 100% of your contribution. In this program, which is actually a limited liability corporation, you have a proprietary reserve account. You're only responsible for your own claims. There is no pooled or shared risk. There is no joint and several liability, which you may have in a trust-type setup. It's proprietary. So essentially, if you had $20,000 in your loss fund and you paid out $10,000 in claims, you would essentially have $10,000 plus whatever interest is earned in your account. That's your asset. We provide you with a fixed annual deposit on a calendar year basis. We provide stop-loss insurance that works on an annual accrual. As I mentioned before, you can earn interest on positive balance. Members of this program earn interest on their accounts. There's an administrative cost to participate in this program. So unlike our bond service program where you pay a premium for the risk transfer, in this case, since the organization has a loss fund, there's an administrative cost to participate. And the administrative cost covers the stop-loss insurance. It covers the surety bond, which is required by the state of Pennsylvania. It covers first non-profits management fee, any commission paid to insurance brokers, as well as a third-party administrator. Like our fully insured option, it's also billed in equal quarterly installments. And like the fully insured option, it also includes claims administration. In regards to cost, this program offers a greater potential reward, but also greater potential risk. From 1995 to 2010, an organization participating in this program would have paid 39% less in unemployment insurance costs than it would have through the state UC tax. So the difference between this program and the bonded service program is really based on appetite for risk, because the stop loss insurance, the attachment point where liability would transfer away from an organization's reserve account or loss fund to the insurance policy, is going to be at a higher point essentially than you would get on a first dollar risk transfer. I mentioned before our unemployment claims service, and this will give you an idea as far as what it's offered. Number one, in regards to auditing of benefit charges, we have a third-party administrator that assists our clients with this specific issue. Auditing the claim to make sure that the wages earned by the claimant are allocated correctly in regards to how much he or she would qualify for in regards to a benefit award. Make sure that a claimant isn't collecting any more than he or she is entitled to in regards to weeks of unemployment. If there's more than one employer that is involved in the unemployment claim, making sure that the employer isn't paying any more than their share. They track credits. In addition to that, they audit charges to wages paid for fraud. In regards to the claims process, they're there to assist our clients through the separation. Processing all separation data at the initial level, assisting our employers as far as seeing what documentation is provided to the state for the state to make that first determination on. After the first determination is made, the losing party can request an unemployment hearing, whether that's done by the employer or done by the claimant. Third-party administrator will provide hearing representation. And the final level is the board of review. And the board of review can't introduce any new evidence, but if there is precedent, similar circumstances in the existing case, they'll submit a legal brief on behalf of the employer. The technical services are really the proactive services. And in this case, it has to do with the hiring and separating procedure. So it may be something regarding your progressive discipline, maybe something regarding your written documentation. It could be a situation where you're evaluating not whether or not to let an employee go, but if you do let an employee go, what's the likelihood that it's going to result in denial of unemployment benefits. So they're there for ongoing consultation. We offer on-site education and workshops. There's also workshops available via the web. There's online access to all of your claims as well as your activity reports. So this is just a service we feel that's beneficial to our claimants who want to take a 100% look at their unemployment cost control. Our third-party administrator is not there to dictate how our clients do business. They're essentially there just to assist them through this process. If you're interested in receiving a quote, you can request an application from Allied. In addition to that, depending on what type of configuration you're currently in, for those that are in the state fund, they would need a copy of your last 3 rate notices, which we have for reference in the next slide. In addition to that, we'd also need copies of your last 12 months of benefits paid statements, specifically to July 1/10 through June 30/11. We'd also need copies of your quarterly wage report for that same period, and that would be the summary page only. We would not need individual employees' wages totals. That can be faxed to the 888 number. If you're an organization that's not in the state UC tax, but in the reimbursement configuration, what we need would be a completed application. We would also need your last 3 years, the last 36 months of notice of benefits paid, in addition to your last 4 quarters of wage reports. So just a little bit different from someone that's currently in the reimbursement configuration. These are just examples of documents that we would need. And the timing requirements are specific to an organization that's in the state UC tax. And essentially, if you're in the state UC tax, the deadline that is required required by the state of Pennsylvania is all the paperwork must be submitted to the state by December 1. Due to the fact that the state fund right now is going through a change in software, that December 1 date is a movable target. Reason being is there's some certain issues right now that are going on. What we'd recommend is having everything to the state fund before the Thanksgiving holiday. If an organization was going to convert from the state fund to a reimbursement configuration on the first nonprofit, there's some documents that we would need to get. Number one would be a copy of your 501c3 IRS certificate. There's a letter of intent that is required to be transferred onto an organization's letterhead. We would provide the template for the organization. They would simply just need to transfer that and sign it. The most important thing right now is, even though there is a December 1 cutoff, with what's been going on, we recommend having the packet complete prior to the Thanksgiving holiday. This would make your conversion effective for the upcoming calendar year. So, for instance, if an organization decided that they wanted to leave the state fund and they sent their packet in December 2nd, they would be opting to elect that for calendar year 2013. So again, to leave the state tax fund for calendar year 2012, all things have to be processed by December 1 at the state fund level. That being said, you can direct all your inquiries to Jeff McCreary at Allied Insurance at 800-569-9427. He's at extension 229, or via email.